Imagine this. Picture waking up on February 20th, 2026, and silver's suddenly ripping higher, trading around $80 to $82 an ounce, up sharply from recent lows in the mid-$70s, fueled by a retreating U.S. dollar after some Supreme Court tariff ruling shakes things up and boosts that safe haven vibe. Everyone's buzzing about the rebound, but here's the twist that grabs you in the first few seconds. While some quiet insider note or leaked email whispers all clear, the crash is over, liquidity's back, volatility's cooling. The hard data tells a completely different story. Demand isn't easing. It's slamming into the market's plumbing so hard the pipes are cracking, groaning, and threatening to burst wide open. Welcome to Elite Capital Decoded, where we expose these elite contradictions so you can stay steps ahead. If this hook has you glued already, smash that like button right now and subscribe, because silver's real story right now is way bigger than the headlines suggest. Let's break it down like we're walking through the evidence in a high-stakes mystery. Silver's been wild this year. It blasted to over $120 in January on fears of shortages and China's tight grip, then got crushed 25-30% plus in a brutal correction. Margin hikes on COMEX, stronger dollar from solid U.S. jobs data, killing rate cut hopes, hawkish Fed signals lingering. Some voices called it a healthy reset, all clear to breathe easy and maybe buy the dip. But look at today's action. Silver's surging back toward $82, up 5 to 7% in spots, reclaiming ground fast. Yet the fundamentals underneath are screaming overload, not relief. First, the COMEX plumbing, the Western delivery system, is under serious strain. Registered inventories, the metal ready for immediate futures delivery, have plunged hard. Recent reports show them dipping below 100 million ounces to around 98 million after massive single-day withdrawals, like 3.2 to 3.36 million ounces gone in one day, then dropping further toward 88 to 90 million by mid-February. Now shift to the east, where China's rewriting the rules and turning silver into a strategic weapon. Starting January 1st, 2026, they rolled out strict export licensing. Only 44 approved companies can ship silver for 2026 to 2027, prioritizing domestic needs for their massive solar, EV, and electronics industries. This isn't a total ban, but it's fragmented the global market east versus west big time. Shanghai inventories have tanked to near 10-year lows, around 318 to 350 tons. Backwardation is at records. Near-term metal costs more than later deliveries. Classic scarcity panic. And Shanghai premiums run $10 plus over COMEX, pulling physical silver toward Asia instead of letting it flow freely. China controls 60 to 70% of refined supply. Their moves hoard for home use while starving Western arbitrage. It's echoing rare earths plays, geopolitical leverage in a trade tension world. The real breaker? Demand, the unstoppable force overwhelming everything. The Silver Institute's latest outlook nails it. 2026 marks the sixth straight year of structural deficit, around 67 million ounces. Total demand holds steady despite some thrifting. Industrial use dips just 2% to about 650 million ounces, a four-year low, with solar PV down 7% to 194 million as panels use less silver per watt via tech like Topkin. But offsets are huge. EVs ramping hard, overtaking gas cars by 2027, using way more silver per vehicle for batteries, wiring, sensors, AI data centers, semiconductors, charging stations, all high growth, inelastic needs. Automotive demand alone grows 3.4% CAGR through 2031. Investment stays robust. Retail chases scarcity, offsetting jewelry/silverware softness. Supply? Mines flat or barely up, recycling lagging. Deficits draw down above-ground stocks relentlessly. So the contradiction hits hard. That all-clear whisper. Maybe liquidity signals improving, post-washout calm, or macro fears easing. Versus data showing plumbing truly broken. Paper markets swing on sentiment, but physical calls dull.